Hello and welcome, everyone. I'm so glad you're here with us today for this timely and eye-opening webinar sponsored by eAssist Dental Solutions. I'm Jacqueline Hurley, and I'm honored to host today's session because we're talking about some things today that impacts every single dental practice's bottom line, and a lot of times it goes unnoticed. So the truth is most dental practices are being underpaid by insurance companies and they don't even realize it. And these hidden gaps don't just affect your monthly cash flow, but they ripple into your financial report, your tax prep, and your long-term profitability. So that's why we've teamed up with someone who deeply understands the intersection of insurance, accounting, and dentistry. And before I introduce our guest today, I just wanted to let you know there is a Q&A at the bottom of the screen. So if you have questions throughout this presentation, please drop your questions in there and we will get to them before the end of the webinar. So I am thrilled to introduce our guest today. His name is Bob Gray. He is a dental CPA and the founding member of Academy of Dental CPAs, an elite group of accountants who specialize in helping dentists succeed. He's worked with dental schools, study clubs, and top programs like Henry Schein's Dental Business Institute. For over 30 years, he's been guiding practices on how to grow their income, manage their business wisely, and plan for the future. And we are so lucky to have him. Welcome, Bob.
Thank you very much, Jacqueline. Yeah, I appreciate it.
Yeah, we're excited. I'm going to let you go ahead and run with this, and we're going to
Sure.
get started.
Okay. Thanks for everybody for joining. We're going to be talking specifically about billing mistakes and things like that. But what I really want to focus on is the big picture, because the big picture is the bottom line in your practice, right? The big picture is what you get to take home. So I want that to be the overall theme for the conversation. As Jacqueline said, I am Bob Gray. I'm really proud to be one of the founding members of the Academy of Dental CPAs. I'm also an instructor for the ADCPA Business of Dentistry courses. We do week-long, courses typically in the Caribbean or places like that. If you're interested, you might want to go to adcpa.org. You can look at some of those things. And I do a lot of lectures to dental societies and programs all over the U.S. Um, I don't know if you've ever heard of the ADCPA. The Academy of Dental CPAs is a group of accountants, not just who happen to have a lot of dentists as clients. They have to actually be in the dental space, if you know what I mean. You've got to have more than 75 dentists, but you've got to really focus on the dental industry. You've got to write for dental economics. You've got to do webinars or things like this so that you're out making certain that dentists understand the finer things, the finer nuances of finances in their practice and make them better CFOs. That's really the whole goal of the ADCPA, and I'm really happy to be a member. If you go to adcpa.org, you can find, on the map, you can find a dental accountant pretty much anywhere. Even the states there that aren't covered with red stars, people are covering them from the other adjoining states. So no matter where you are in the U.S., you can find a true dental specialist. People ask me all the time, so Bob, well, that's great, but why do you specialize? Aren't the tax rules all the same? What's different about dental? What I found though is that it's not that they're different, it's how they're actually applied. Too many times people I say they have a tax preparer, but not a tax strategist. They have someone that they can call and ask questions to, but how do you know which questions to ask? The thing is, if you're a dental CPA, you know which tax deductions a dentist should have. You don't have to ask the dentist. You can draw out from them and make sure that you're getting the actual minimum legal amount of tax that you have to pay. So all the ADCPA members are actually, know mesial from distal and how to point to tooth number 8. So I always say if your accountant can't, find one that can. Again, I'm going to start with the ways to increase your bottom line right from the very beginning. Um, the obvious answer is increase revenue, decrease overhead, and decrease taxes. Okay, Captain Obvious. Welcome to the webinar. But the real question is, okay, how? How do I do that? Where do you really want to focus your efforts? And if you're focusing your efforts strictly on operating overhead, you're probably missing the big picture. Increasing revenue has the single biggest impact on practice profitability of all the efforts and all the time spent that you will as the CFO, CEO, Chief Marketing Officer, HR Director, you may be one and all for your practice. But when you take time away from clinical dentistry to focus on those issues in the practice, the one thing that will generate the most return on investment for you is increasing your revenue and focusing on ways to actually be able to do that. I mentioned people miss the big picture. As an example, if you have $1 million practice and you can cut your clinical costs for lab and dental supplies from 13% down to 11, that's a 15% reduction. Woohoo! Good for you, right? And that produces $20,000. But how long did it take to do that? How many people did you call? How many phone calls did you make to suppliers? How many of your friends did you talk to say, well, who are you using for that lab and doing whatever? You look at all that time that you spent to create that benefit. What, in fact, if you had now taken that same amount of time to boost your collection ratio by 5%? I mean, that effort would have produced $50,000. And what I find, again, is that too many people miss that big picture. Um, I definitely want to focus, make sure you understand when we walk away from this webinar today that thinking about that, when you put your gloves and hand instruments down and really think about working on the practice rather than in the practice, look at the actual top line of your P&L, because that's really what makes the difference, increasing the bottom line. Everybody listens to radio station WIFM, What's in it for me? Well, what's in it for you is the bottom line. I could have a $10 million practice, but if I have $10 million in overhead, I don't really have that much. So I think it's really, really important, as I mentioned, to talk about the bottom line. The other thing we talk about, though, is amazing to me how many clients never look at adjustments. If I ask you, you'd say, well, okay, I have billing clerks that take care of the EOBs and they look at all that sort of stuff. Yeah, but that's the problem. You always need a second set of eyes looking at those adjustments. And if you know that realize that adjustments in my experience throughout my career, fooling with adjustments has been the single biggest amount of fraud and embezzlement in a dental practice. If you're charging $1,600 for a crown and it's a $600 insurance write-off, and if you got a $1,000 payment from insurance, fine. But what if someone who's doing the posting also had access to the cash drawer? And what if they posted an $800 insurance write-off with an $800 payment? The problem is everything looks great. Your deposit and your day sheet match. The patient has a zero balance. It all looks like it's perfect. The problem is $200 just kind of snuck out the back door. And again, it's a difficult thing to catch unless somebody is really, really looking at it. I also see a lot of things where claims are rejected and they just never get resubmitted. People are too busy. You've got a lot of things on your plate. Your billing clerk may also be, helping to answer the phone at the front desk. It might be doing things like that. I think you know that sometimes people get distracted. So what if somebody was reviewing those? What if somebody was actually looking at all that stuff and trying to make sure that you were on track for collecting 100%? Let me give you an example. I think the best example we can give you is some real live data. Accountants get to be Monday morning quarterbacks. The accountants get to be the people who see after one of my dental clients goes and does something, makes a project in the practice, makes a change in the practice. I get to see what happened to the profit and loss statement after that. And so I get to see what's successful and what's not successful. Not maybe sometimes not because I'm so incredibly smart, but because I'm paying attention to what dentists do that work. Here's an example of a client in Chicago. $168,000 in AR from dental insurance companies. They had an overall 86% collection ratio. They signed up with eAssist, and 6 months later, it dropped from 168,000 to 30,000 in insurance companies. Improved the overall ratio, but the big thing is within that 6 month period, there was a $138,000 reduction in the AR. Now, what did that increase in overhead? Really not anything because it was already produced. The money was already produced. You just hadn't collected it yet. And I guarantee you that if I ask anybody here if $138,000 influx of cash over that time period would be a good thing, many of you might say game changer. But I think a lot of you, if you look, you might find that you do have, AR, some older insurance ARs, and some things that really need to be reviewed and tested. So let me give another example. Um, here's a dental practice out in Riverside, California. They had 127,812 in AR just from Medi-Cal. They were, eAssist was able to drop that number significantly by collecting 125,587 of those dollars. And again, 125,587 in extra revenue suddenly sort of came in pennies from heaven. And I would tell you that it's not, and you can say, well, gosh, that was a one-time thing because now they've reduced my AR. But what if your practice never got in that same bucket again? What if you never had to deal with that problem again? And again, it's very difficult for many people to hire the staff capable of doing that on a very continuous basis. I would tell you honestly, and I am not paid to do this today. I am doing this because I love the dental space. I love helping dentists be better CFOs. And I'm an honest suggestion. Write down that phone number, that 844-327-7478. Because what other phone call could you make today that might add 100 grand to your cash flow this year? There's not a lot, right? And I would tell you that we're going to be a QR code that pops up at the end here. They have the opportunity for a free consult. They'll look at your AR and they'll tell you, what can I help you or can I not help you? And I think you would owe it to yourself to at least engage and see what that free consult looks like for you, because I think it could be a game changer in terms of cash flow. Just a quick thing I want to give a little bit of background on eAssist. I thank them for hosting this here today. You know, they do pretty much soup to nuts when it comes to all the aspects of revenue cycle management. They're talking about, to me, the biggest thing is that they're trying to collect 100% of what's rightfully owed to you. And that's what every dentist wishes their front desk and their back office would be able to do. Some with more success than others, if you know what I mean. Submitting clean claims, doing all the things you see on the screen here, but getting that insurance balances over 90 to near zero, making certain that insurance companies are paying for every penny that they actually owe you. I think that's key. Now, they have a lot of other ancillary products and services, and many of you are probably already paying another vendor for insurance verification, eligibility, that sort of thing. But from the accountant's perspective, let me tell you the one thing that I really want to point out, and that is the deposit reconciliation. How many of you listening today always take the day sheet home or look at that and compare it to the deposit ticket, and then compare the deposit ticket to the bank statement at the end of the month? And then maybe if it's not you, do you have somebody for sure who's doing that and not the same person who's making those deposits? Is it another pair of eyes? Because opportunity is the key in a dental practice to embezzlement and fraud. And creating that opportunity is really just a lack of systems in place and a lack of extra eyes looking. There, one of the things that eAssist will do for you is actually compare the cash that goes in as compared to what the billing system says was cash that went in. And I think that for a lot of people, that would be a huge relief to know that those two numbers match. We try to work hard to help clients do the follow-ups and make sure that they're reviewing EOBs and reviewing day sheets and things like that. I would tell you in your practice, there's nothing better than creating the aura that you're going to be caught if you were to do something fraudulent in the practice. Nobody would run into the casino, grab all the chips off the table and run to the front door. You'd get caught, right? So if you can create that same kind of aura or the same assumption in your practice that there's just too many eyes looking, and I'm going to get caught if I do something fraudulent, you can obviously improve the chances that you won't be, a victim of embezzlement during your career. A huge benefit. Let me switch and go talking about taxes. I mentioned in the beginning, one of the things that you can do to improve, overall cash flow is enhance revenue. And I think we've already seen some ways that I'm suggesting you contact and find out about that. But the second thing is actually tax planning. Many times I find that new dentists who are new to us come on board and save a significant amount of income tax just because of either poor communications or just lack of good advice and some things like that. And so again, I find that that's the second best way to improve your overall revenue as compared to chasing after overhead. Now, again, maybe if you're wildly overstaffed or you've got some other big issues, yes, you might want to deal with those. But enhancing revenue and saving taxes are probably the two number one and number two things you can do to increase your bottom line. So I want to talk about some ways to do that here today. I'm going to talk about ways to increase and maximize the QBI deduction, the pass-through entity tax. We're going to talk about depreciation and accelerated depreciation, retirement plans. I've got several other planning tips in here. So let me just sort of jump into that. You all by now should have heard of the QBI, or the qualified business income deduction. It's 20% of your actual income from the practice other than W-2 wages. So if you're an S corporation, it's only your K-1 that is subject to this 20% tax reduction. But what a sweet deal. I only have to pay tax on 80% of the money that I actually earn under this program. If you're an S corporation, you want to make sure that you've balanced the S corp income on the K-1 with your W-2. Because remember, I said that W-2 wages are not part of this 20% reduction. It's only the dividends and the pass-through income that comes from your K-1 that would be subject to this 20%. So planning for that really becomes pretty important, because a 20% tax, write-off is a pretty sweet deal. You want to try to make sure that you're taking advantage of that. Let me start with talking about just purchasing equipment. I mean, I think a lot of people think, well, that's obvious. It does say, but I'm not sure everyone understands all of the ways in which equipment, really has an effect on taxes and cash flow. For this year, the Section 179 limit is $1,250,000. That means that that's the maximum you can write off of new equipment purchases if you bought it all this year. For most practices, that's not a problem, right? You're not going to be buying way over $1,250,000. And if you spend more than $3.1 million, you're not eligible. The Section 179 was sort of meant for smaller businesses. It's not for General Motors. And again, I don't think that applies for most of the people here today. That's probably not an issue as well. Bonus depreciation started at 100% going, back 4 years. It now is limited to 40% upfront, but it's unlimited. So none of those other caps above there would apply. And this deduction works for new, used, any kind of equipment, any sort of thing you have whatsoever. The key is it must be placed in service before 1/1/26. And placed in service means plugged in and available to be used. It doesn't mean actually used. You could literally unplug it at midnight on the 31st, or plug it in, take it out of the box, whatever it is, and have it available for training or for use or something. And even though it's not used by a patient, it is deductible. I get a lot of questions from clients at the end of the year saying, hey, Bob, it's already the 30th of December, and I'm about to buy this piece of equipment. What if I write the check for it today, but it's probably not going to arrive till January 10th? Is that still deductible? Well, the correct answer is no. The correct answer is it's got to be in place and in service by the time that happens. I know there's a lot of people that push that rule a lot, because once the check clears and they see that there's an invoice and they see that that's it. But if the IRS were to really look for shipping documents or for proof of installation, that could be an issue. So make sure that when you're going to do these kinds of expansion and do the planning, you're not trying to do it all on December 30th at the very last minute. People asking me also too, what's the difference between Section 179 and what's bonus depreciation? What's the difference? Well, Section 179 is 100% of what you purchased. Bonus is 40%. But the problem is some states treat these deductions differently. Some states have caps on Section 179, and they don't have caps on bonus, or vice versa. So it depends on which state you're in as to which one of those two you would want to choose. your tax preparer, your CPA should be able to certainly help you with that particular decision. But make sure that you're looking at the state income as well as, the federal tax deduction. Let me give you an example though of somebody that just goes out towards the end of this year and buys a piece of equipment. Let's say it's $150,000 of equipment that you're going to buy. Now, what I want to show you is the actual cash flow effect of that moving forward. Let's look at the summary on next April, April 30th of 2026. If you finance this with one of those programs that many suppliers offer where there's no payments for 6 months, you've actually paid zero by April 30th of 2026. But you got a refund of $45,000 on taxes or a reduction in the taxes for 2025. The thing people forget is you also get a reduction in the required estimated payments for 2026. And that's a big deal because it initially drops by just April 30th, it drops your cash flow by $55,000, or improves your cash flow. The thing is that a lot of people say, well, I've taken on this new technology or some new piece of equipment and I had a learning curve. I had some problem. Well, great. Now you've got $55,000 of extra cash flow to help you over the ease of that learning curve and some extra things like that. I think that people don't realize that it's those two things together to do it. And I mentioned it's also for 2026 as well. The thing is that for prepayment of your taxes, you're required to pay 110% of the tax that you paid in the previous year or 90% of the current year in order to avoid any penalty. So if I lower my 2025 taxes, that has an immediate effect on the 2026 required minimum payments. By lowering the tax by $45,000, because of that 110%, I get about a $40,000 tax reduction. And yeah, it's not a true reduction. It's not free money. But if I gave you $40,000 today and said, hey, tell you what, you don't have to pay me back until 2027, no interest. Again, what a sweet deal when it comes to cash flow, because that's the name of the game is all about, right? Keeping the cash in your pocket. And so it's the 2-year effect of buying income that a lot of people don't realize and aren't aware of. And the same thing applies to all entities. I mean, I gave the example I gave you here was an LLC or a sole proprietor, but S corps are exactly the same. S corps can work that well. Even C corps can work that well. I hope most of you listening are not C corps these days because of all the other rules that used to apply 30 years ago that made C corps useful have all pretty much gone out the wayside. So if you're still practicing as a C corp, you might want to talk to your accountant about switching and electing to be treated as an S corporation if that's right for you. But the same thing applies because all of these equipment purchases, even if you're an S corp, would reduce your actual K1 income. And I'm going to show you an example of that as it's kind of compared to the QBI, or weave in the QBI deduction as well in a minute. But just realize every one of those. In C corps, you can do it. It just means that you need to now back off on your salary at the end of the year, knowing that you've got this equipment expense coming up that's going to zero out profit. So it just requires a little bit of extra front end planning if you're a C corp. Here's an example I wanted to show you to show you how dramatic this difference could really be. The QBI has a phase out for dentists and a lot of other professionals like accountants, unfortunately. If you have joint income above 394,600, it starts to phase out. That 20% gets reduced until you hit 494,600 and then it's gone. You're not eligible if your income is too high. And you can see the single there is 197,300 to 247,300 if you're a single taxpayer. But look at the first column here. Without Section 179, if I had a practice net income of 530,000 and I had some itemized deductions of about 35,000, I've got 495 in taxable income. Problem is I'm not eligible for the QBI, right? That's the problem. And so I'm going to wind up paying 122,840 in federal income taxes. But what if that dentist was the one who on November 1st bought that $150,000 worth of equipment? Look what happens to the actual tax difference when you do it that way. by dropping the taxable income down to 269, or the practice down to 380. It's because we picked up a $76,000 deduction, not just the equipment, not just the $150,000. Now I get another $76,000 tax deduction just because I planned my gross income and worked it down to be eligible to be in that window for QBI. In that example, this dentist got 47% of the money back that they, the cost of the equipment they purchased, 47% back in year one right away. And I might not even have made any payments on it yet, right? So I'm going to get $70,000 in tax savings pretty much right away in that example. That is huge. It's a much bigger difference than a lot of people think. Many people think, oh, well, I only get maybe I'm in a 30% tax bracket. That's all I get for deductions, but it can be significantly bigger than that. So make sure if you're contemplating equipment purchases that you're planning accordingly. The pass-through entity tax is something that was created back in 2017. State and local income taxes were limited to $10,000. And so some states have enacted an opportunity for the practice entity itself to pay the state income tax on the pass-through income. So again, if I'm an S corporation, a partnership, if I have a K1 pass-through income, the dental practice can actually pay the state tax on that profit that's getting passed through to you, and then take a federal tax deduction for it. And that's a workaround. That now it's not limited to $10,000. You could pay $50,000 in state income taxes from your practice and take a $50,000 deduction. Many states have, a few states have not. Obviously, check with your tax preparer to see if you're living in a state that has A, income tax, and B, PTE tax. But if you're in one of those states, you definitely want to take advantage of that. Don't let that opportunity get away. Again, a quick example. There was a dentist with an S corporation that had 266 in wages and 350,000 in K1 income, total 616. But if they paid 17,500 in state taxes from the practice, that reduced the federal taxable income and saved them $6,100. That $6,100 would not have been saved had they actually made outside estimated tax payments. Estimated tax payments with coupons from your personal, checking account that are not going through the practice. They would not be eligible for that same $6,100 tax benefit. So this can be a pretty big deal if you live in a state that has income tax and, works with PTE. One of the other big tax considerations I think that a lot of people aren't aware of are two things. One is cost segregation studies, and we're going to talk in more detail about that. And then relocating from a lease space, how much of a tax deduction that really brings. I don't know if, many of you may have office spaces where you went into maybe a shopping mall, maybe a unit, whatever, and you did the build out. You don't own the space, but you actually had to do a big build out. I'm sure that applies to many of you. And now I go along and oops, I've outgrown it. It's time for me to do a practice expansion. Well, what people forget is there's a big tax deduction associated with that. It's called the unamortized leasehold improvements. Basically, you're abandoning those leasehold improvements when you move out of the old office and go into the new office. And so as an example, if you did 300,000 of leasehold improvements way back in 2015, and now you're going to move out in 2025, you've probably been amortizing those things for many accountants over 39 years. Although maybe after you hear this webinar, you'll realize there's another opportunity. But I see a lot of people that do a 39-year amortization because it's real estate. The thing is that when you leave that old office, you get a $215,000 tax deduction all up front, all at once, because you abandoned those leasehold improvements that are now all screwed into that space that you left. And what a huge immediate tax deduction. And again, when do you need those tax deductions the most? It's usually when you've just taken on a big project, you've got a big loan, and you probably have a big lump in your throat as well. What a great time to remember that you're going to get a big tax deduction at that time when you make that move. I want to talk about the benefits of cost segregation. I call it how to turn studs and drywall into Section 179 eligible expenses. A lot of people have never heard of this concept, and it's been around forever. It's amazing to me how this is just something that kind of gets passed by. Here's the general concept. Let's say you build $1 million building. If you're in a 40% tax bracket for state and federal taxes, you're going to get 400,000 in tax savings either way. But the question is when? Well, if I don't do a cost segregation study, I'm required to do 39 years, and it's actually 40 years because it's a half a year the first year and half a year the 40th year. Anyway, it turns out to be about 10,000 bucks a year. Okay, wow, whoopee, $10,000 a year or $1 million investment. But if you did a cost segregation study, and this is a very, very conservative example, I could move 20% of the cost of that building into 5-year equipment or 179 type deductions, another 10 grand in 7 years, and 8% in the 15 year. That would produce an $80,000 tax deduction in the first 5 years. And again, when do you need these big tax deductions? It's when you've just taken on $1 million in debt to build a big building, and you're chewing Rolaids, right? The best time for that tax savings is have the government kick in a little bit of extra tax dollars right now. That's the time when you really, really need it. There's a lot of numbers on this page, but this is just a sample of the kind of study that you would get if you did, and these are free analyses that many of the companies will do. They just show the actual difference between the depreciation with and the depreciation without. I put this one up because this is an example of $500,000 in tenant improvements. You don't need to own the building in order to do a cost segment analysis. If you're doing significant tenant improvements, it could be a big game changer. Here's an example again of extra tax savings. 500,000 of just build out produced $67,000 worth of tax savings in just the first 6 years. So it can be a pretty significant thing either way. If you don't, forget anything else or just remember anything else about this whole conversation about cost seg, without a cost segregation study, you're going to take $1 million building and just it's going to be 10,000 bucks a year spread out. But if you actually break it into its components, it's going to be a big advantage for you. Let me give you a quick example. If I were to ask you what this is, most people would say, well, yeah, it's an outlet. Well, but now the question is what's plugged into it? Because if a piece of equipment, dental equipment, is plugged into it, now it's dental equipment. It's no longer a building, it's no longer an outlet. And the outlet itself, all the wiring, all the way back to the breaker box at the main panel, and part of the building costs associated with the planning and the electrical permits and everything becomes that could become a $400 tax deduction just for one outlet. And again, it's equipment, which is Section 179, immediate tax deductions. Big difference. Here's just a decorative sconce, a lighting sconce. Should this be 39 years or could it be treated as equipment? Obviously, the answer is equipment because it's not part of the structural component of the building. The thing is that all the electrical, all the plumbing, all the infrastructure that goes into a dental office to build it is part of what becomes dental equipment. So all of that is taken away from the building and put into dental equipment. What doesn't qualify is the actual load-bearing walls and the exterior windows, that sort of thing of the building. And land never qualifies. Unfortunately, land is not tax deductible. So that's not going to be of any help. But remember that doing this can be a really big deduction. One of the other things I want to talk about is, I've had, doctors say to me, oh, I didn't pay any taxes at all last year. Okay, well, I'm going to go, nah, maybe that wasn't a great thing. I mean, I put up the tax brackets for 2025 here. The 12% tax bracket stops at $96,950 for married filing jointly. I would argue the taxes were on sale when they were only at 12%, right? If you had an opportunity to take that $96,950 and bring it down to zero, you only saved 12% to do that. I would much rather have taken that, $96,000 in tax deductions and used them against a 35 or 33% or 37% tax bracket down the road, right? I think that at the end of the day, too many people are focused on getting that tax down to zero, and it's not really a good thing. So remember that one of the main concepts. The second thing is that when you build a new building, many times you've got a ton of new equipment to write off. So we're talking about the building portion of this as being a big write-off. But what if you say, well, Bob, I only had, 400,000 in taxable income, and I bought 400,000 worth of equipment. Well, I would say, okay, let's take 300,000 of that as a Section 179 deduction, keep the other 100, so we're going to pay some tax or somewhere in that neighborhood. And then what we'll do is we'll wait to do this cost segregation study, perhaps until year 2 or year 3, because now my practice income is up, my net taxable income was about to be up, and what you're allowed to do is push these cost segregation studies out so that you get the first 2 or 3 years of depreciation all in the year that you pick to start that study. And so it can be another way to just knock your tax, bill way, way down in those early years of practice expansion. So keep that in mind because that can be a very big, factor when you're looking at the cash flow or the affordability of, practice expansion like this. One of the things I want to talk about is just, putting your kids on the payroll. Many people see, you've seen this, Meet the Doctor, you got their family on the website, that sort of thing. The thing is that the Screen Actors Guild in 2025 set the union minimum session fee at $782.60. There's a 350% surcharge for union members for unlimited use of that photo. I mean, that makes a photo worth about $2,739. There was an old court case that where grandpa paid a 2-year-old, to actually be an actor in a commercial. And the IRS audited them and said, hey, now they're only 2 years old. They couldn't possibly earn $20,000. The grandfather fought and won with the IRS because the court said, well, yeah, I know that the daughter was not a union member of, Screen Actors Guild, but I don't know, from looking at a picture, I can't tell who is and who isn't. So if the Screen Actors Guild has made a video or made a picture worth this under the union scale, that's what it's worth. So I think you have a pretty good, stance to be able to say, hey, I should pay my kids as models if they want to be on the website. The thing is that people don't realize how much this really could turn into. Here's a quick example of just using modeling fees. What you can be holding your child in your arms and use them as a model because I'm a family dentist. I want to show them in the community, yada yada. But what if I paid that person, if I had 3 different images that I used, website, maybe a patient brochure, maybe it was even something in the office itself. What if I had 3 different images and I could justify paying $8,200 to my child? The dentist takes an immediate tax deduction for that because it's payroll. So the net cost drops to about $5,000 a year. The thing is that the child pays no federal income tax on that. 0, because that's under the limit of earned income for any child, no matter what age they are. But now the child has the ability, because they go to W-2, to have a Roth IRA. A Roth IRA is they can contribute the $7,500 to that from their $8,200 in pay. And if they did that, what an amazing gift you could give your kid. At age 65, assuming 5% growth, it's worth $2 million. So if you want to give your kids a heck of a gift, that's an opportunity. What if you just said, well, I just want to invest the money for college? So at age 18, even, they start to withdraw money out of their savings account, out of the Roth account, because you can withdraw all the money all the original principal that you put in, even though you're not 59 and a half. There'd be $231,200 at age 18 sitting in that account to be drawn out for the potential for college. And they still have 3 more years of $8,200 you can pay them to help living costs and things like that. The big thing is that rather than just reaching what I call hip national bank and having to pay the kids, and this is the practice paying them in tax deductible dollars. What a sweet way to pay for college. I think though that if you can also make sure you're going to document this properly, we have a little contract that we use. We staple a copy of the photo to it. You sign it off as the guardian parent, and agree that we can use this image in our advertising. Blah blah blah, and of course file W-2s, file tax returns, and do all the things to make sure that it's clean. But it can be I think that can be a pretty big deal. The other big expense that I see missed a lot of times or not incorrectly done is pension contributions. We have a lot of people that started out early in their practice career and said, listen, I'm going to start with just a simple IRA plan. That deduction fits me. That's the size shoe I can jump into at this point early in my practice. And then years go by, and they call us and say, hey, I'd like to do one of the complimentary reviews that we do for clients who are interested in coming on board. And I'll look down and see a simple IRA, and I'll say, well, doctor, could you afford more than that? And they'll say, well, oh yeah, I just didn't know what else was available. Well, you could have been putting, say, $70,000 total into a 401k plan. Okay, again, opportunity might have been missed, right? 401k plans have a voluntary contribution max of 23,500 or 31,000 if you're age 50 or older, but they can also do some matching on top of that. So that can be a pretty significant difference. What people don't realize, though, is the big bang is the defined benefit plans. You could actually put over $400,000 as a contribution to a defined benefit plan and take a tax deduction for it all upfront in that particular year. And if you combine it with a 401k, it's over $470,000. The big difference is it's got to be the right census of employees. And if the doctor's older and the staff is much younger, those things can really work. I have a client who put away about $350,000 for himself, and the total staff cost on the bottom was about $11,000. So again, much younger staff, much older doctor, it worked out pretty well. He was trying to boost the retirement there at the very end. So make sure you ask yourself the question as you go into the year, do I have the right pension plan? The other thing is the tax-free rental of your personal residence. I hear this a lot. Way back when the Olympics were here in the U.S., the IRS or the U.S. was kind of embarrassed. We didn't build hotels fast enough. Congress came up with this idea of letting people rent their house out for 14 days and making it tax-free. The thing is that people like, or the Extreme Makeover at Home edition, if you've seen that before, they're rushing in 14 days to rebuild somebody's entire house. Well, the reason is they're paying them $50,000 in rent called equipment, appliances, that sort of thing. And that's the rental fee for the week. So these people get to keep all those improvements and all that furniture and all that things for free because it was all performed in 14 days. So again, if you're going to have staff meetings, if you've got a legitimate reason to have a meeting, and you would otherwise have gone to a country club or rented out a banquet room or done something for that, and you want to have it at your house, just get a quote from the country club or the banquet hall and say, what would it have cost me to do it there? And then bill your practice and charge it off as rent. And it comes back to you as tax-free income of your rental income on your house. A lot of tax deductions I see for young doctors get missed. When you were in dental school and you bought an articulator, you bought loupes, you might have bought hand instruments, you've got dental textbooks, all that sort of thing you had when you bought them for educational purposes were not tax deductible. But now I get out and I start my own PLLC. I am an independent contractor working with a couple practices. I'm an associate and I want tax deductions. Well, when you now have the ability to convert all of those educational purchases to business use, they all are immediately tax deductible. And that includes your cell phone, your laptop, the printer. I mean, a lot of other things that you're using for business. Don't forget to pick those things up. And if you missed them in the beginning, remember there's a 3-year window you can go back and make corrections for an amended tax return. So don't let those deductions get away. I say all this because I think there really is a paradigm shift. I think that if you really, really want to, succeed with corporate dentistry and all the other competitive, pressure that there is, I think you really, really need to work on your CFO skills. I have to say, though, I think that too many clients kind of just go in the front, the back door and do the same thing they did yesterday and kind of put their head down. I like to call them my drug addicts. They're hooked on hopium. And that is the worst drug of all, because if I just go to work and hope that the staff's going to get it done all day, I am probably one of those drug addicts. Hopefully that doesn't apply to anybody listening here today. I hope you find that that's not you. Again, the key takeaways, I want to focus on revenue enhancement. That's absolutely the key here. Make sure that someone's reviewing adjustments. Make sure you have another set of eyes in the practice looking over what's really going on. Use tax savings opportunity as the second best choice because that's the one I think you're going to want to use past revenue enhancement to get the best return on investment. Make sure if you're in a state that you've got pass-through entity tax that you're using that opportunity, and choose wisely before taking Section 179. Again, if you get your taxable income down to zero or $10,000, I don't think you really did the right thing. You might not have really truly helped yourself in the big picture. Saving those deductions for a 30% tax bracket would be a much better thing to do. And you really can turn studs and drywall into equipment and not a building. So don't forget the benefits of that cost segregation study. Um, one of the things that we do at Gray Pilgrim, if you're interested in even reviewing your tax returns or the thought of becoming a client, if you will set up a time to do a consult, we will look at your prior year's tax returns and tell you for free whether or not we think there's any opportunities that you're looking at. We'll make some suggestions, and there's truly no obligation. If you want to have the review done and then go back to your current accountant and see if you can implement some of those things, it's fine. We're happy just to educate dentists on ways to save the most amount of tax and pay the least amount of legal tax. So do me a favor and jot down the bob at gpallc.net, or our phone number is 717-263-8713. Feel free to reach out, and we would be happy to do a complimentary review for anybody that was interested in that. I want to go back to question and answer. There's a QR code here, though, that you can either scan. If you didn't jot down the phone number for eAssist before, there's a QR code you can scan here and schedule a complimentary consultation for them. And I would guarantee you, based on my experience, if you go through that consult and you have some AR and they realize that they can help you, you would be very, very well suited to actually try to align and take advantage of their services. So I'm going to leave that QR code up while we're talking about questions. Jacqueline, I didn't get a chance to look while I was talking. Were there any questions in the Q&A box?
I don't see anything in the Q&A box. So if you can think of anything that's valuable that maybe you want to reiterate at this point.
Again, I think I don't want to go crazy on the soapbox of this whole, fraud and embezzlement, but in my career, there's been way too many clients that have called us and said, "Hey, Bob, I have a friend, and that doctor works just as hard as I do. They seem to gross the same amount, but gosh, he or she's driving a brand new Mercedes, and I still have my old Corolla. What's wrong? I don't why is my practice different?" And I've too many times we picked up the financial statements and looked, and yes, doctor, you're grossing $1 million in production. Good for you. Great practice. Why are collections only $600,000? Well, the answer is if the dentist doesn't know, the answer is you probably have a problem. And there's too many. I mean, I could go on for hours about the stories about front desk clerks that have set up a separate bank account, about just all kinds of ways that unfortunately doctors who are not paying attention are subject to that kind of fraud. And so again, I think the real benefit of having anybody, eAssist included, looking and have those extra eyes in the background be a great comfort to a lot of dentists who are busy, being clinical dentists. You're busy in the operatory. You can't be watching all the things that happen at the back office and front desk. So having that extra set of eyes and ears, I think, is just key.
That's great. We did have one question come in. It says a startup S corporation dental practice has more loss than W-2 income on a 1040. Can the loss be suspended and used in the future years to offset the 1040 income?
Yeah, the loss is, but I would just tell you that again is an example. Unfortunately, I don't want to rub it in, but it's a bad planning, because in fact, what happens, that meant your taxable income went to zero that year because you took a W-2 that you didn't need to take, right? Because if there's not enough, if that W-2 wiped out the taxable income. For anybody listening, if you're considering the possibility of starting another practice, or if you are an associate somewhere, you're going to buy a practice, you definitely want to start out, if you're in the right state, California excluded, you want to start out as an LLC or a PLLC, professional LLC. You can always switch to an S corp after that. But the first year you would have exactly avoided the problem that particular viewer was talking about. There's In a PLLC, there is no such thing as I had to take a W-2, but then I created a loss by doing it. You only pay tax on whatever the taxable income is, and you've got a lot of control over that because you can control the depreciation deductions and the elections that you make. So you got way more planning opportunities with that LLC. Later on, when your income's above 500,000 and you're maxed out of the QBI deduction, you can send in a one-page election. You can elect to be now taxed as an S corp. You keep the same federal ID number. It's very, very simple. But now you got the best of both worlds. You got to start out and take all your tax deductions, and you get the S corp advantages as the years go on.
That's great. Thank you so much for answering that. It
Mhm.
looks like we don't have any other questions. Thank you so much, Bob, for sharing
Sure.
valuable insights with us today. And thank you to our attendees. Thank you for taking time out of your day to join us. We hope this session provided you with some practical next steps that can kind of just help your practice be more financially secure if you're realizing that there may be gaps in your billing or areas where underpayments are affecting your bottom line. Now is the time to take action. And I know the QR code is, up if you want to go. And if you kind of don't, if you miss that, you can go to dentalbilling.com. Our goal at eAssist is to help you collect 100% of what's rightfully owed to you and just make sure your revenue cycle supports and not sabotages your financial goals. So thank you again. There is a quick webinar, a post-webinar survey, just a couple of questions on there on how would you rate our session? And if there's any other topics that you would like in the future, thank you again for being here. And we look forward to seeing you next time. Thank you, Bob.